private capital, it's a fascinating time, $378 worth of dry powder. There's a lot of money chasing increasingly fewer assets. Where are you finding value amid all of that competition?
Well, it's a great question. Again, thanks for having us on. I think that the good news is now that the vaccines have rolled out, economies have reopened, the markets themselves are open. We've looked at about 1,300 deals in the last 12 months, and we've seen record M&A levels, but that also goes to record LBO activity. And a lot of what we do faces private equity firms who themselves are sitting on record levels of dry powder. And the way to think about it is for every euro they invest, they require roughly €1 from a lender like us. There's certainly a lot to do. And our business model is we tend to be local. We have 75 investment professionals all over Europe, 6 local offices. So we're really turning over rocks and stones in all the different countries all around Europe.
Let's get specific. You're in every country, but what are the sectors you're most interested in right now? What looks the most attractive?
Sure. I think our fundamental goal, and this really served us well both during the financial crisis and more recently during COVID, is to back the best businesses in the best sectors that we can find. In particular, that tends to take us to telecommunications and software. Also, healthcare has been good for us. Non-balance sheet financial services, things like insurance brokerage, things like wealth management have all been very, very stable and frankly, very good credits.
It does seem, though, that majority of the market has been stable, maybe to the surprise of many people. I think the default rate never surpassed 2% in 2020. Did we just skip that part of the cycle, or is it still coming?
Well, we think there are a lot of challenges left. Hopefully, COVID itself is more in the rearview mirror than ahead of us. But there are a lot of macro factors on our mind. I think there are 4 key ones that we're most focused on. The first is rising fuel and energy costs. The second are supply chain issues and a lot of sand in the gears there. Third are rising raw material costs. And lastly is tight labor. And I think when you put all those together, the Bank of England is forecasting 4% inflation. That's something we have to deal with. And in terms of the supply chain, we had gasoline lines and shortages like the 1970s just a few weeks ago in the UK. We're wondering if there are going to be holiday presents on the shelves in Christmas time. So I think there are a lot of bumps in the road that we have to be mindful of. But the bigger question is, how does it impact rates? The Bank of England signaled a rate rise last week. Didn't happen, but we think it's going to in the near future. Luckily, we invest in floating rate assets, but overall, we think there are going to be real economic implications once rates start to rise.
Yeah, this concern we definitely hear is they've held, so perhaps they have to act even more aggressively once they finally do move over at the BOE. And really, this is a global phenomenon as well. What does it do to the world of private debt if we all of a sudden do have that tightening throughout the Western world?
So I think it really depends how much and how quickly. The market, as you know, hates surprises. When we run the math on our businesses, we provide credit at a level where, frankly, if rates were to go up 100 basis points, maybe 200 basis points, they're okay from a cash flow perspective. Anything more than that, we're probably at the table talking to the company about how they're going to meet their obligations.
Okay, and have you had to have that conversation at all leading up to that? Has there been concern about meeting those?
I'd say not yet. Okay. Again, our asset class, this is one of the nice things about it. COVID was one of the real first tests of our asset class, because in particular in Europe, it's probably less than 10 years old, but it's performed incredibly well, I think particularly because we've backed a lot of these stable businesses that remained open and profitable during COVID.
Let's talk about fund size a little bit and deal size, because Ares had the wonderful superlative of being the first fund to have an $1 billion deal in this space. What do the superlatives look like now? How big are they getting at Ares?
Sure. I think one of the interesting trends that we talk about a lot is, yes, we raised an 11 billion euro fund, but the deployment's gone well. And one thing that's really interesting is the markets are really moving to scale. They're focusing on larger businesses. So for example, we've now done a couple of transactions of over $1 billion in size. And the reason is the capital markets themselves, 40%, this is a stat from the US, we always say, 40% of the market in the US 15 years ago focused on companies with tranche sizes 300 million or less. That number today is 2%. We are becoming more relevant as our own capital base grows to larger and larger businesses. We're quick, we're confidential, we can do public to privates. We can also provide growth capital that the bond and loan markets can't to help companies grow and their stakeholders reach their objectives.
So I also know that you've been a very vocal proponent of ESG and really Ares as a whole. Often when we think about ESG, a lot of times it's around public companies. There's a question of data, even around public companies. But of course, in the world of direct lending in private credit, it's even more opaque. Does that make it a more difficult prospect to invest with an ESG lens?
We think it's the other way around. We're at a point where for Ares as a group, it's incredibly important to us. It's also important to our investors who trust us with their capital. And we're at a point now where it's moved on from being a passive check the box size to thinking about how we can more actively drive positive ESG outcomes. Remember, a lot of the time we are the sole lender to these companies. We have real influence and scale. So what we're doing, I think, are three things. The first is we can actively promote sustainable business. We can invest in recycling businesses. We just did a £1 billion loan to an environmental consultancy business to help them reach more clients, to help them reach their sustainability goals. And further, we've actually added some financial incentives for them to do more on the ESG side. And the second thing is, the other point is, remember, our average company, it's not that big, maybe 100, 200 million of revenue. So we actually have a lot of internal ESG resource at Ares that we can bring to bear. We helped a UK company in our portfolio develop their own internal ESG policy from scratch. So again, these are all things we can do to bring the power of Ares, the resources that we have, to the middle market.